So, good afternoon and welcome to Investing Your Administrative Reserve Considerations for Nonprofits, a webinar for nonprofits being hosted by the Washington County Community Foundation in partnership with Stein Wealth Advisors. I'm Alicia Walls, Chief Operating Officer of the WCCF, and I can tell you that we were really excited to see the number of registrants we had for this training today. A great peace of mind can come from having an administrative reserve, and this seminar has been specially designed to provide you with some considerations as you and your board determine how to make this financial tool best work for your organization. We're fortunate to have two very knowledgeable speakers teaming up on this presentation today. Joe Piszczor has been working in the financial industry as a financial advisor since 2006, shortly after graduating from Mercyhurst University. Throughout his career, Joe has been driven to empower and educate those with whom he has had the privilege to work. In 2020, Joe joined Stein Wealth Advisors, where he continues to practice and grow within the industry with his friends Josh and Melissa. At Stein Wealth Advisors, he works with diverse clients such as generations of families, businesses, and charitable organizations from all over the country. Joe and Stein Wealth Advisors, the team at Stein Wealth Advisors, are passionate about serving the community and always keeping their clients' best interests first. Joe's passion for service has been ingrained in him since a young age, as his mother, Kathy, always encouraged him to give back and help others. Throughout his career, Joe has served in various roles throughout the community. Currently, he is a trustee of the WCCF, and he chairs our investment committee. Betsy True, president and CEO of the Washington County Community Foundation, is a well-known member of the local charitable community who has spent more than 20 years at the helm of the WCCF. Under her leadership, the assets of the foundation have grown from less than $250,000 to more than $50 million, with over $25 million in grants and scholarships cumulatively awarded. Throughout her tenure, Betsy has served as the primary liaison for the foundation's investment managers, helping to ensure that there's prudent stewardship of the foundation's assets as well as growth. So at this time, I'm going to hand the floor over to Betsy.
All right, so welcome. Reiterate what Alicia said. We're glad to see so many people on the call and so many people interested in prudent investment and management of your administrative reserve. So Alicia, would you go to the next slide, please? So lots of different investments that you can be talking about, different time periods for those investments. So we want to point out that this is just the administrative reserve investment class. So that while there might be some similarities with others, this is about the administrative reserve. So what is the administrative reserve? It's money set aside intentionally by the nonprofit, typically by the nonprofit board, to continue your operations if you have some unexpected losses of income or unexpected increases in expenses or both. Essentially, a lot of people call it the rainy day fund. I've heard it called the slush fund. I wouldn't use that term. Rainy day is probably better. So the industry practice is to have at least 6 months of current operating budget in your reserve, and preferably 12 months of your current operating reserve, operating budget in your reserve. If you're not there, if you were on in January, we did, administrative reserves and lines of credits. And if you did not participate in that, you might want to go back. It's on our website, and you might want to go back and look at that presentation after today, because it ties into this particular presentation. So finally, on this slide, I want to point out that the administrative reserve is different from an administrative endowment, although the investments may be similar. Administrative reserve is something that your board has said. It's from your unrestricted money, and your board has said, okay, this is our rainy day fund. An administrative endowment is permanently restricted, or an assets with permanent restriction, and only a donor may restrict a gift in that manner. If you have an administrative endowment, there are some additional rules and regs that you have to follow, and you have to look at Pennsylvania trust law. So this is not about investing your administrative endowment. This is about investing your administrative reserve. Next slide, Alicia. So I know that some of you have some monies in some administrative reserve. So let's just take a look at, say you were fortunate to have $250,000 in your administrative reserve, over a 5-year period. We've shown two scenarios. One, you've taken this super conservative. We don't want to take any risk. We have to have this money. If we need it, it has to be available to us. And so you put them in, a money market that paid 1% annually over the past 5 years. The second scenario is you took that same $250,000 and you invested it in a balanced portfolio that earned 6% annually. And you can see there the huge difference in earnings, $12,000 compared to $87,000, so about $75,000 difference. Now I can tell you that over the past 5 years, I would have loved to have gotten a 1% return on our money markets, because you just weren't getting it. But I can tell you that we earned well above the 6% annual over the past 5 years. So it was a really great time to have money invested in the stock market, because it was just through the roof. Next slide, Alicia. So as you what's the appropriate mix for your charity? We have people on the call I know who are sitting on maybe $100,000 administrative reserve. And I think there are some people who are approaching or in excess of $1 million. So what should your asset, what should it look like? Well, essentially, it depends on how big you are. So generally, smaller funds are invested in mutual funds and exchange traded funds, often called ETFs, while larger portfolios also have some individual stocks and bonds in addition to the ETFs and the mutual funds. And I can tell you this is exactly the way we were. Before we hit our first $1 million in endowment, we were 100% mutual funds and ETFs. There was no way we could get the diversity that we needed in the portfolio. Joe's going to talk about diversity in a little bit, but there was no way that we could get the diversity by holding stocks and bonds, because we just didn't have enough money to make that happen. When we hit $1 million in our first million, that is the point where we said, okay, we're going to start adding a little bit of individual bonds into the portfolio. But I can tell you, even today, and our portfolio has grown considerably, we still use ETFs and mutual funds. In particular, we use the mutual funds for our international equity position. We don't own any international stocks individually, but we own international mutual funds to get that component within the portfolio. So next slide, Alicia. So my goal today is that you're going to walk away with two major takeaways. So hopefully you're going to walk away with lots of information, but I have two major takeaways for you. Takeaway number one: do not utilize a DIY model. This is not a do-it-yourself type of a exercise. Hire an investment firm. Why would you do that? One, to fulfill your fiduciary duty. They know what they're doing. You want to get qualified investment expertise and guidance, and that will help you to mitigate risk on the investment, and obviously to enable your charity to do what it is that you do, rather than trying to figure out how to manage your endowment. Just contract that out to a qualified investment professional. So remember, first takeaway of the two takeaways: no DIY models. Okay, so I'm going to turn it over. Joe's going to tell us about what are the common investment vehicles.
All right. Well, thank you, everybody, and thank you, Betsy, for that. I just wanted to say very briefly, Betsy, thank you and your team at WCCF and Alicia for picking the bar up for all of us in the charitable sector here in the county. I think that I know some of my peers from some of the boards that I serve on or served on are on the call as well. And I think we all have benefited from the work of WCCF. So I'm allowed to give a little commercial, and I think that is well worth it. And all your efforts are very well placed. And thank you guys. So Anyway, as everybody said, I'm Joe Piszczor. I'm a certified financial planner with Stein Wealth Advisors, and I've been in practice, believe it or not, for about 16 years. So I've done this, and whether you are just learning some of this verbiage and vernacular, or like some of our guests have been the CFO of a Fortune 500 company, I hope you can pick up a little bit in here. So let's start real basic about common investment vehicles. So stocks and bonds are our most common investment vehicle. When we own a stock, we own a piece of a business. When we own a bond, we own a piece of debt. That is the simplest way to describe that. Now, from that, we compile these different securities into products that are a little bit easier for folks to build out their portfolios. And the most common, as Betsy alluded to, are mutual funds and exchange traded funds. I don't want to get into those too much, and obviously we can talk about those, but mutual funds carry a little bit different how they're treated from a tax standpoint, and exchange traded funds typically are going to follow some sort of algorithm to mimic some sort of part or a piece of the stock or bond market. We also talked about, Betsy, if you can find that 1% money market, I would love that. If it could be more like 4% to help me pay
I
some
hear
inflation.
Northwest Savings Bank's offering 5%.
Well, that would be wonderful. And as we perhaps see a Federal Reserve with a tightening monetary policy, we will see higher interest rates, and it will be easier to make money on these things that will help your administrative reserves keep pace with inflation. But I think that's part of why we're talking about this. And again, go ahead.
Did Chris Classby have a heart attack? He didn't respond to that. Maybe he didn't hear me.
We're waiting for him to recover, Chris. If just wave if you need us, we'll send help. But anyway, our more fixed vehicles or FDIC insured vehicles, these are our guaranteed type of products, our money markets or CDs, where the FDIC insurance is backing those up, and that would be like a fixed interest rate. So if you say, we know we need to make this rate on this money, that would be more how you would do that. Oh, Chris, thanks, Chris. We appreciate you being speechless. That's the first time Chris Classby has been speechless. Coincidentally. So anyway, so let's move on to the next slide here. So let's talk about some factors that we may consider when selecting which type of investments to have. First, like Betsy had alluded to, how much in resources you have may determine what complexity your portfolio takes on and how you may divvy that up. Also, and if you haven't seen the first presentation, I think that was a wonderful way to explain to folks how to appropriately use credit in a line of credit, but how your cash reserve is set up for your organization and what vehicles you have to give you flexibility in adverse conditions is certainly important. So whether you have a line of credit, access to other cash, or how you're structuring that is very important. And then lastly, how willing are you, your committee, and most importantly, your board and your donors willing to accept risk, and being very honest with yourselves about these risks and what would happen if, let's say, we were in an adverse market environment and you needed some of that capital. So I think these are very important parts to think about when we go through this, and something to be very honest with your board about. And some boards are more risk adverse than others, and that is certainly okay, as long as you're honest with it. Next one, please. All right, so let's talk about mitigating risk. So when Betsy had mentioned, hiring folks like myself in my professional life, or when I sit in a board position or we sit on a board, how do we hire these folks? So what makes people qualified? Well, one is credentials, right? We can look at different designations or time in business, but the key thing that I would say when looking at hiring an investment firm or professionals is fiduciary standard. As long as they're held to being fiduciaries for you, whether by their credentials or just how they operate, highly encourage that. And that helps you as a board satisfy your fiduciary standard. Not all advice is equal. So that's a fair question to ask. Next, establish an investment policy statement. We're going to be going through all of the fun parts or some of the fun parts you may want to consider with your investment policy statement, and comply with it, right? It's great to have these documents, but I think we all know, just like your estate plan, if you stick it on the shelf, it doesn't do you good. You must go through it and look at it from time to time and make sure you're adhering to it because it's an active document. Next, diversifying your portfolio within the different asset classes. We're going to talk about how to look at benchmarking a little bit and how to quantify how should we look at these investments so we get a fair comparison. So we think that's important, but making sure you're diversified across the major market classes is important. And then lastly, that our investment goals and that we're monitoring the performance. So when we get into the benchmarking and how to track your performance, not all things are created equal. So we want to make sure we're doing fair comparison of our managers so we know whether or not they are doing their job and if they are adding value to our relationship. So good. I think I'm turning it back over to Betsy to tell me how you would hire somebody like Stein Wealth Advisors or one of our other wonderful local firms.
Yeah. So, and we've been doing this for a long time. I've been doing this for a long time. And when we have, when we're approached or when we RFP for investment services, it's about people, processes, and fees for me. So first of all, the people, as Joe mentioned, I'm going to look at, their credentialing, how long they have been in business, their assets under management. In my particular case, I will also look to see, are they managing any other assets for a community foundation? And if they are, then I of course make a call to that community foundation. So you want to look at people. What you don't want to do is when a board member comes in and says, oh, my nephew, oh, he does great. He's our stock picker and he does a great job. And then you just get lured into that, because somebody knows somebody, whether it's a nephew or a son or whatever. Now they may be qualified, but that alone does not make them qualified because they know somebody on your board. So processes. So these are very important. They'll be important for your accounting on your administrative reserve investment, as well as determining performance. So some questions to ask, if they don't already tell you. How is money transferred in and out of the portfolio? What types of investment vehicles does the firm provide? So we want to work with somebody. There's a tendency by some to push out annuities, life insurance annuities, and as an investment. And while I think there might be some place for that at some point, not in here, not in your administrative and reserve investment. So you will need to account for any change in market value of your investment on your financials. So you should be expecting an annual, what I call an accounting statement, just says what's the beginning balance, any inflows in or out, and then what the change was, what the market change. So you can post that to your financial statements on a monthly basis. And then performance statements, they're different than accounting statements. And they should be you should get them at least annually. Sometimes you can get them more, the bigger you are, the more frequent you would expect to get. We get ours monthly. But at $100,000 investment, you probably would be looking at a once a year report. And I personally like to have them electronically, so my staff doesn't have to scan that stuff in. We can just go online, pull it down, and there it is. This is an important question. How frequently is the portfolio rebalanced? You're gonna, when we talk about the investment policy statement, we're gonna talk about target ranges within your investments. So much equity, so much fixed. If let's say the stock market runs really, really high like it did last year, if you don't rebalance, you're gonna have more in equity than your portfolio will let you, that says you should have. So you need to rebalance some of that. On the flip side, it would work the other way. So if the stock market goes down, you may have too much in fixed and not enough in equity. So you need to rebalance the portfolio, again, no less than annually. I think this is an important one too. Is the manager willing to come and meet with your board on at least an annual basis to talk about performance, talk about expectations, at least on an annual basis? Just as a comparison, we meet with our managers at least annually, but with our major portfolio, we meet with them twice a year. For many of you, I've talked to, and I know you do not currently have the ability to accept stock gifts. This is your opportunity to get that ability. choose a manager who has the ability to accept stock gifts into the portfolio. Whether or not it's going to stay in that portfolio, I mean, that's determined on a different basis. But a lot of stock is called a thing called DTC. It's just an electronic transfer in kind from the donor into your account. And you want that, it has to be in kind for the donor to get the maximum tax advantage on that, so that you don't want the donor to sell the stock and give you the cash. You have to be able to accept the stock directly into your account as what's called an in-kind gift. So for many of you, like as we've had those individual conversations, are you accepting stock? And we don't have a mechanism. I would include that in your expectation for your manager. So, and then finally, what fees are charged by the manager? You know, to this day, I get managers that come in and try to sell me that their services are so great that they deserve 200 basis points. And I just chuckle, just chuckle. Really on anything like up to $1 million, you should expect roughly 100 basis points. That equates to 1 percentage point. And so that just generally is the standard. Again, $1 million, 1 basis point. So anything under that. Be careful. Sometimes mutual funds have hidden fees, and you want to look to see the fees that you're in. There's a thing called net asset value. You can talk to Joe individually later, and he'll tell you what that is. But just be careful of the fees within the funds, and also be careful of an organization that's oh, I'll do this for 75 basis points. I just told you the market is 100. I'll do it for 75 basis points. Oh, that sounds like a deal. Except like on your $250,000 endowment or administrative reserve, but they have a minimum fund fee of $2,500 or something. So it doesn't matter that they are only charging 75 basis points if they have a minimum account fee. That's going to be the cost. So just be careful of those situations. So 100 basis points on $1 million. All right, Alicia, you can go to the next slide, please. So this is
all right. So Betsy, I have a couple quick questions and follow up from that slide. So what you're saying is we should interview a couple different firms just to see, you know, what the differences are. And you gave us some great questioning there, but you would recommend maybe interview a few different ones when we do an RFP or?
Yeah, well, I think that you're not going to, it depends on how much money you have, whether you could even issue an RFP, but you might get a conversation. And I would have a conversation with more than one for sure. And if you have an existing provider, have a conversation with, you know, maybe 2 other ones just to gauge, am I getting the best money? Remember, you have a fiduciary role here to manage this money. So you want to make sure that you are doing it in the lowest cost way that you possibly can and still get great service for sure.
Thank you, ma'am. And what Betsy was alluding to regarding the products is some firms have their own products, and it's more than reasonable to ask, do you use proprietary products? And if so, how do I know that they are in my best interest? So certain firms, that's a more than fair question. That's the way that you would want to say that. And in regards to the fees, right, especially mutual funds, oftentimes fees get buried within them. So when you ask, say, I would like to know about the gross internal cost of these portfolios, because you will more than likely pay your institution and manager, your custodian, and for your products that are within there, whether they be normally, like Betsy said, an ETF or a mutual fund. So that's, please just be careful on that. If you ever have a question, I will provide you all of my contact info. Just call me and I'll let you know what the way I see it. And that's how we do. So, so moving on to the slide. Thank you, Betsy. Those were all very good points. And quite honestly, folks, Betsy has had to vet out more people like me in her career than anybody that I would ever want to, that I would ever wish on somebody. So take her advice on this. And she has been very diligent in vetting these types of professionals for decades. So she does have quite a bit of experience. Not to, not that you need that, but Betsy, you do know what you're talking about. Those that if I were getting interviewed, I would love it if somebody asked me all those questions. So let's talk about apples to apples and oranges to oranges. So if and when your organization determines, okay, this is the risk level that we're okay with, this is the stock to bond mixture, we want to make sure that we're comparing our portfolio apples to apples. I'm sure everybody knows the first one on the list, the S&P 500. Show of hands, who knew there were other ones other than the S&P 500? I didn't see a couple of them. I know you do, Betsy, and a couple of the other ones, Dave, and a few. But most folks, they look at the three indexes, the NASDAQ, the Dow, and the S&P 500, and they think that represents the entire market. Believe it or not, all of those indexes are just to let us track parts of the market. Case in point, the S&P 500 tracks our large companies, and it's a weighted index. But when we look at how we compare our portfolios, we want to make sure we're looking at a fair comparison between the two. So the S&P at the end of the day, when you see it on the news, that is what did the big companies in the US do today? Not the mid or the small or what the companies across the ocean did. That's what the big companies did. Our S&P 400 and some of the other indexes follow the middle-sized companies and the small companies as well. And we also follow the bonds. The US Aggregate Bond Index is how we track what the bonds in the general market are doing. And we can get very nuanced in how tight we get our indexes and our blended benchmarks. Lastly, you can track non-US, non-Canada stocks with the MSCI. And these are just some examples, but remember that the market and the stock and bond markets are all in many, many different pieces. So when you and your organization say, this is the mix that we feel comfortable with from a volatility standpoint and from a return standpoint, that's when you can say, okay, if we are this percentage this and this percentage this, now we can see how should we have been performing over that time period and get a more relative number to base yourself off of. So can we go to we'll get one more, and I think this will clear this up for you guys. So let's talk about blending benchmarks. So at the bottom of the page, you can see 3 examples of some mixes that are people will use for different portfolios. So I would argue the one on the bottom, the 80% equity and 20% fixed income, that would be a very aggressive portfolio. That would probably be like somebody trying to seek return and doesn't mind a lot of volatility. But if you're an organization that doesn't like volatility, or you don't need as high of a return, perhaps you would use something more aligned to the 65-35 or a 50-50. And these are things to be discussed at your investment committees. But hear me out on this. So if we had our portfolio and it was half stocks, half bonds, like the first example, and we looked at what the S&P 500 did, and it was a good year, it would look like we did very poorly, because only half of our portfolio is that. So what I would say is when you work with your managers, take some time to define your benchmarks at the beginning of the relationship, so then you have a good, clear way to compare yourself and your manager's performance to see if they're keeping up with what they should do, because that's really what we hire investment professionals do. Help us manage risk, most importantly, and try to get us to the return goals that we set and help navigate us through these waters. So I think, Betsy, did I summarize that for you with the blended benchmark?
Absolutely. And so we've used it very simple illustration here, but really, if you're going to, when we talk about more diversity, it would be, more, if you did a 50-50 would probably be like maybe 40% S&P 500, 10% S&P 600, that type of thing, with a little bit of international. But on this particular slide, we just want to show how you blend the indices to get your target. So you are comparing, as Joe says, apples to apples and oranges to oranges in your comparison.
Great. Well, we want to go into the investment policy statement now. And these are the documents that you're going to work to develop with your committees. And I believe, Betsy, we sent out a draft one for everybody that you made.
We did.